Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are modeling out the impact of the coronavirus as we look to get back to work. And Phil, it seems as if markets are responding to more realistic assessments of experts, as nearly a quarter of the U.S. working population is out of work.
Yeah, I'm not sure that the unemployment data itself is what's triggered this, though. I think the last couple of days we've had a few experts on TV talking about the fact that this is going to be a lot harder than people had, I guess, without thinking so hard, thought. So we had Fauci on TV a couple of days ago talking about how coronavirus was going to be a potentially longer-term problem to get over and to get around. We had Jay Powell yesterday saying the Fed was ready and expecting to have to put more into the market and potentially for a prolonged time. So I don't know if the unemployment data today it's not actually that far from expectations. It's slightly better than expectations. So I think people are actually just starting to look at whether we have a swoosh or a V, or even potentially a W recovery. And at the moment, I think the consensus is coming around to a swoosh where it's a little bit harder to get people back to work than we expected. Some of the data coming out of the states that are already opening is starting to support that as well, where you shut the economy down in a week or two, it's taking a lot longer to get everybody back to work, and even if they get back to work, the customers aren't coming straight out either.
Well, Phil, if we look at our first two charts for today, studying the probability of a recovery using data from the 1918 pandemic, these two charts also indicate that the damage could potentially be longer, as some of those experts and Fed Chair Powell suggested.
Yeah, I think the chart on the left is interesting. It's from JP Morgan, and they're just showing that based on the economic data, it looks like the market's valuation should be a lot lower because the expectations based on the economic data of recovery are much lower or much slower, at least, than what the equity market is pricing in. We've talked before about how the forward PEs are making the market look pretty expensive. And a lot of people have said you can't use the forward E because it's going to be recovered so quickly. But that is the essence of why the equity market looks expensive. It's pricing in a market with a V-shaped recovery where we get back to last year's earnings pretty quickly. And the impact on corporate profits this year and next year, and especially the year after, is not as significant and maybe minimal by 2022. But looking at the economic data and looking at some of the, as we talked about, the recoveries state by state, country by country in Europe, even in China, we've talked about how slow they've actually found restarting factories, getting people back to work, being at full capacity, whether that's just because of supply and demand constraints or people's human behaviors. But there is a lot more challenges getting us rebooted than there was shutting us down.
All right, and let's move beyond COVID-19 and onto one of your favorite topics, ETFs. And today we're taking a look at the top 25 ETFs in the past month.
Yeah, so the way that we calculate the top 25 here is we're basically looking for ETFs that have a combination of strong asset growth, strong volume growth, and strong returns. And we kind of combine all those forces together and see which one's the most interesting in the market. And so this is the top 25 based on a combination score. And you can see, if you look through the list, there is a lot of technology. There's cloud computing, there's innovation funds, there's online retail. You can see the thematic working through there. That the work from home thematic is definitely attractive to ETF investors. The Nasdaq Qs, which we've talked about, are exposed to a lot of the same companies, and they've performed really well. A couple of days ago, they were positive year to date, and they cracked $100 billion in assets. So there's a lot of technology ETFs that are trading pretty actively and have had good returns and have had good asset growth. There's also some biotech and healthcare ETFs in there for obvious reasons. It's all related to COVID. And then on the downside, you've got some Brazil exposure, where Brazil has struggled with COVID. It's got a much more open and laissez-faire attitude to testing and the disease. And I think the market's pricing that in, and people have been withdrawing money from the Brazilian fund. And real estate as well. I guess with all of us comfortably working from home for 2 months now, people are reassessing real estate and also just looking at rates, what that does to the real estate funds. What's interesting, given a couple of weeks ago we were talking about USO, is that oil has kind of dropped off the map here. This screen we're running on a daily basis and USO and all of the oil and energy complex was in the top 10 consistently. And now the only one that's really there is XOP down at number 25. USO has completely dropped off the list. One related ETF that's also been hyperactive is the JETS ETF for obvious reasons. With as we've talked about, the airline passenger loads are actually the airlines have shut down capacity about 25%. There was a chart today that said the passenger loads are back up about 70%, but that's obviously on not many planes flying. So the JETS ETF, as people place bets on whether that all of the companies in that field are going to survive and how well they're going to survive, has been hyperactive as well. And obviously a good way or an easy way to express a view on that industry.
Yeah, it's really interesting to see how much you can discern from ETF fund flows. Phil, great to have you with us as always. Thanks for joining me on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.